Hello and welcome back to the final note of 2015, a year which I suspect is going to go down in investment history as year zero. Here's why. This chart shows you the total returns, so that includes dividends on stocks and coupons on bonds, for the S&P 500, for the Barclays Aggregate Bond Index, and for cash, which is represented by an ETF of T-bills. And you can see that in all cases they are below 1%, and they are all within 1 percentage point of each other. I can't find any other year in history where the three main US asset classes have been so close to each other and all so close to zero. Now, that is fairly easy to explain. Earnings were flat, rates were flat for almost the entire year until the Fed finally raised from zero right at the end of it. Inflation was flat. There was very little to move asset prices here in the US. There were big shifts going on in the US economy, in the world economy. Those were played out in the currency markets and the commodities, but these mainstream US asset classes remained as they were. And you think of all the angst that went in from financial planners deciding on asset allocations between stocks, bonds and cash, they simply needn't have bothered. Now, what will break the impasse in 2016? Well, the critical variables are, first of all, earnings. There is a belief at the moment that earnings are going to grow for the S&P 500 by some 8% next year, thanks to a low point of comparison. I think that strikes me as a little optimistic. Earnings tend to be cyclical, and it looks as though they've peaked. Then, of course, we need to know about rates, and as we've discussed many times, the Fed and the market have different views on that. We will live and learn, and we will discover far more as 2016 progresses. Now, this is the last note for this year. We will have some look backs on 2015 for you, as well as some previews for 2016 over the festive period. We'll be back in January, and I'd like to wish everybody a prosperous new year.